all of a sudden yesterday we had a $4 to $5 jump in Fed cattle cash in the north.
Hi, everybody. Welcome back to the Comstock channel. I'm Marlon Bowling with you again. Just to remind you, make sure you like these videos and subscribe to the videos. How do you do that? Well, all you do is click on that little bell icon down below, and that way we can let you know whenever we upload a new episode so you stay up to date. And also be sure and share these podcasts with friends and relatives so we help spread the word. Thanks to you, we have become one of the fastest growing podcasts out there in the ag realm, and we thank you for all that support. And we continue to keep pushing more critical information out to you, and thanks for your help. Today, I've got Eric Relph with me of Comstock Investments, and he joins me to take a look at Friday's market action. And we got a lot of signals out of the markets, depending on if you're looking at the grains or the livestock. Eric, they were going in opposite directions here today. First of all, let's talk about the grain markets. I was looking at the last 10 minutes of trade on Friday, and they just completely tanked. What happened there?
I think what you had was, I'm going to throw something up here just so we can have a little visual aid. I think that helps a little bit, but I think what you had was you had a lot of price laters coming through today, and this was kind of a deadline, and many grew weary of, okay, do I keep holding on to this? Do I pay to roll it forward, or do I just go ahead and make the sell? And I think that's why the second half of the session, we had the sharp weakness that we saw, particularly in the corn and soybeans, but the wheat kind of followed suit as well. But you talked about the last 10 minutes. You can kind of see this is a 5-minute chart, and I don't know how well we can zoom on that last bar, but that was pretty significant drop off right there at the finish. And that was encompassing the after session there in the last 5 minutes. And so right there at the end, it just fell off a cliff. So we'll see when we come back out and see how they decide to trade it. But you can see the July lost 8.5, while the December gave up 5.75. We finished those at 450 and 470 respectively. So that was back below the 100-day moving average in the December corn. It's, I don't know, it's not overly meaningful unless you get consecutive closes. But yesterday we popped up above that 100-day, which I don't know if we'll be able to see that pink line very clearly, but we popped above it yesterday, closed well above it. Then today we sucked right back down and settled below it. So we're kind of at a do or die moment in that December contract. One day does not make a market.
Okay, so on corn or soybeans, which one, let's say, looks worse right now, or which one is faring a little better in your opinion?
Well, really, you're kind of similar. I'm looking at the new crop contracts, and the corn definitely looks a little better. You've got a firm uptrend over the last 2 weeks, and you can see that here in these last 10 bars. You're moving higher highs even today, even though we finished lower. But in the case of the soybeans, you've been sideways to lower here these last 8 or so sessions, as you can see here at the tail end of this chart. And so the corn definitely does look better overall, but I think the fundamental storyline is kind of shifting a little bit. And now we're starting to see daily flash sales to China and unknown destinations, which is often China as well. So, those kinds of things can really spark the soybean market. And when they get moving, they can move fast.
You had talked with me before we started recording about the recent drought monitor map.
Yes.
And let's take a look at that. And you said you had made some observations on that latest map that came out. What are you looking at?
It's pretty easy to look at this, monitor and think, okay, this is a vast improvement from what we've been seeing. And you look at the heart of the Corn Belt, and I'm talking Iowa, Illinois, northern Missouri, even Indiana, Ohio. There's no real drought consideration through the central portion of the Corn Belt. You've got pockets in southwest Kansas and western Oklahoma, including the tip of the panhandles, and then it's the extreme southwest or mountainous regions. Now, granted, there's a lot of pasture ground up in the northwest areas that are suffering from a little bit of drought, but it's not your primary grain growing regions. And so I think that is going to keep a little lid on us for a while. I just think that traders have to recognize that even though a lot of areas, including right where I'm at, have had too much rain, the crop that's going in is going in really good conditions in a lot of parts of the country, and we can't get backyarditis as we look at this stuff.
Yeah, that's a good point. And I know that I've talked with several people here on the Comstock team, and in reference to the, I guess, above normal moisture that you have seen, let's say in the central, the northwestern part of the Corn Belt, you have a full moisture profile all the way down.
Yeah.
So it's going to be hard to really talk a lot of drought unless you get one of those flash droughts before the corn gets very big. I will point this out. You go in the Mid-South region where I'm located. I'm actually north of Nashville. Corn's almost tasseling out already. I mean, it's head high on me, if not higher.
Yeah.
Man, you get hot, steamy conditions like this, and I mean, it's just going to explode right now.
We know what that looks like. I mean, we come from an area that often turns into a hairdryer, as I always called it as a kid. You just walked outside and it'd take your breath away like you were sucking on the end of a hairdryer. But the flip side to that is this soil here. I mean, we hold over 11 inches of water in the soil here in Northwest Iowa. And so when you have a full moisture profile, those roots don't have to work. And if you turn off and you hit the top of that with some really hot and dry, especially if it's accompanied with wind, you'll suck the life out of that top couple inches, then the roots won't chase. And so it could create some bigger issues down the road. And, you know, even though the drought map looks conducive to a nice crop, you take into consideration some of what we've been seeing, and then add into it this extended forecast from the GFS that was just released this morning.
Ooh.
And I mean, this map is showing widespread 4 to 5 inch through the heart of the belt, including Wisconsin, Minnesota, Iowa, Nebraska, down into Missouri, basically from Kansas City up to Duluth. And within that broader 4 to 5 inch area, you've got some pockets of 7 inches of rain, and this is over the next 10 days. We have forecasted rain for 10 out of the next 12 days, and that is not going to be a good thing when we get going here.
Well, earlier in our discussions that we have had in recent weeks, you have alluded to the fact that it seems like we're running on the calendar of the market clock, let's say, maybe about 2 weeks ahead of time this year.
Mm-hmm.
Do you think that's still the case? And would that mean that we would have an early top in the market this year?
Well, I'm not sure. My personal opinion may vary a little bit depending on where you're at in the country. But, you know, here we're behind. We had a 2-month planting season. It's just been unbelievable. But when I was in Kansas, you know, the wheat was well ahead of schedule. On Memorial Day, I noted to many people that it looked like 2 weeks it'd be coming off the field, and everyone kind of agreed that was the time frame, and that ended up being the time frame, and now it's gone. In the specific area that I was at in Southeast Kansas, and I'm sure I know that they're working all the way up to the Nebraska border in areas right now. So that is, well ahead of schedule, weeks ahead right now. But here, you know, we're 30, 40 days behind normal. And so what gives and what impacts the market more, I'm not really sure. You know, you talked about tasseling in your area, and we've heard the same thing in Texas. And so there's a lot of two-sided coins here, and I don't know which one the market's going to focus on. Right now, I would say we're looking at rain makes grain. That is usually the case in June and July, even though in a lot of Minnesota, Iowa, Wisconsin, we're in this situation where we need some dryness and we need some heat. And people in Southwest Kansas that were experiencing 102-degree temperatures yesterday aren't going to be very happy to hear me say that, I don't think.
You were describing what I always call a flash drought a little bit ago, where you have wet moisture wet moisture. You have a wet soil profile, and then all of a sudden you turn hot and dry and the top dries out. That could be a threat in the central Corn Belt there. But it sounds to me like if that's going to happen, it's going to happen within the next 3 weeks, maybe.
Yeah.
And if it doesn't happen, it's going to be exceedingly hard to get a major rally in the market that time of year. Isn't that right?
That's right. And there are things pointing to maybe a delayed rally in this market. And so anything's possible. We never know what the market's going to do for sure. We can only point to what we have in front of us and the data that we have to work with. And right now we have extremely strong basis levels all over the place. And that, I believe, is a funnel that's filtering out from cattle feeding country in the panhandles in Southwest Kansas, moving north and then northeast. And so you end up with this, I talked to a guy up by Mankato, Minnesota this morning, and he said in the last 10 days, they've gone from 30 under to 7 over on their corn basis. And I believe that is a result of $1.40 and $1.50 over basis in Southwest Kansas, funneling north and east. And with the ethanol plants here competing, we've got a lot of regional ethanol plants that are bidding 30 and 40 cents over the market right now. So that is not indicative of a ton of grain sitting in farmer hands, because with the dips and the volatility that we've seen as we're now upon Father's Day and very close to 4th of July, this is a time frame where we'd be doing some cleanup sales, and we have price later contracts coming through. So again, that could be rooted in what this weakness today was rooted from, and maybe it's short-lived, and we may see a little contra-seasonal market action here.
Well, I thought 3 or 4 weeks ago, we just had a ton of farmer sales that hit the market when it looked like the top was in there. And I thought the basis fell apart there for a while, at least in your part of the country.
It did give up a lot. And that was when the May contracts were coming up. And when that was happening at the end of April, that's the time frame you're talking about. So you're talking 6 weeks ago. When that May was coming to maturity, we did see a collapse in basis, because we saw a lot of deliveries for the same reason. You have basis contracts or price laters based off of that May. People didn't want to pay to roll; they just liquidated, and so you saw this mass liquidation. Market sells off, and then we recovered nicely following that, and here we are again coming up on late June.
Well, again, the old axiom is usually the markets can't really stage a big rally until the commercials own over half of it. Are we there?
I believe so. Yeah. For some reason, and I can't put a finger on exactly why, for some reason, the contra-seasonal aspects, we've got strong ethanol grind, we've got a strong export market, we've got uncooperative planting conditions. By all accounts, if you listen to climatologists, we're likely heading into an uncooperative growing season, and the agronomics of this planting season won't be known for quite some time. And this just all kind of feels like we could have another contra-seasonal year like what we went through in 2020.
Why is China buying so many soybeans now?
Well, the finger likes to get pointed to the idea that the Brazilian government is putting restrictions on their soybeans and not doing the tax credits and things of this nature. I don't know if that's necessarily the case, or if it's just a matter of China is always logical in their purchasing reasoning. They're either buying because the price is right, or because they just simply need the product. And Matthew had pointed out that Matthew Cruz, president of Comstock, had pointed out that the exports were running quite shy of last year, and maybe what expectations were for this year, indicating that maybe the grain wasn't there. And now China shifting to old crop U.S. purchases in the month of June. That's a little surprising. And maybe more surprising than that is we still don't have any new crop booked with China for this year, for the upcoming year for new crop.
One thing I haven't heard much talk about is Argentina. Now, last year they had a terrible crop, and last year they didn't have enough to even crush. They're a big soybean crusher.
Yep.
This year it sounds like they have a pretty good crop. Now, isn't that going to really kind of turn the soy meal market on its head, or what's going to happen there?
I was going to say, they're meal exporters, and they're the largest meal exporter in the world. And I believe that is one of the reasons that our U.S. meal has had such a struggle. That combined with the fact that we're really going after the beans for the oil, for renewable diesel, for sustainable aviation fuel. Oil is the hot product, and meal almost becomes a byproduct. I don't know what the timeline of that's going to be, but I actually thought it would be this year, but so far I've been proven wrong.
The wheat looks pretty ugly on the charts. It's harvest time.
Mhm.
How long are you going to ride this thing down, or before you think maybe it might be time to re-own some? What do you think?
Well, I'll throw up I guess, a thought process that I've had here for a couple of days. Now the Chicago and KC are both kind of working in the same way. So now, because there's not all the congestion, we can definitively see this pink line here. That is the 100-day moving average. In the July Chicago, that is at 604. You can see we've kind of got close enough to call it flirting, but we've never truly tested it. So the closer to that we can get, the more apt I'm going to be a buyer. And I wouldn't be risking a ton from there. But I think that that could be a technical point that would hold this. If that takes it out, then the funds are going to continue to pile pressure. And I'll show you by comparison, the KC also very close to that 100-day moving average. And this is 11 out of the last 13 sessions have just been straight down. So this is not a good look technically, but again, getting close enough to that 100-day moving average where it might start attracting some technical buy-in.
How do Ukraine and Russia fit in right now? It sounded like they had got some rain recently.
Yeah, I think that's kind of a bit of a muted point for the moment, at least. We're always one headline away from that mattering, but Russia's production, by all accounts, is going to be down, and most likely in a big way. Ukraine's going to continue to struggle right along with them because they get the similar weather patterns, and so I think there is a storyline there, but we've already seen Russia elevate their prices as much as 20% over the last couple of months, and U.S. markets haven't really responded in earnest. So I think when you look at the market and the headlines that are coming out of the Black Sea region, it's really not much of an influence to the U.S. on a trending basis. Day to day, yeah, you could see some reactions.
Okay, let's talk about the market with the gold star on Friday. That would be the cattle.
Yeah,
And man, oh man, it was up and away on Friday. So what does that tell us?
yeah, it was. So a couple of things here, and I guess I'm going to show you one thing before I go to another here. This is the USDA's 5-area daily weighted average for fed cattle. And all of a sudden yesterday, we had a $4 to $5 jump in fed cattle cash in the north. You went from struggling to get packers to bid on anything to just blowing out the top end, and a lot of 195, 196 live in the north, and anywhere from 305 to even 309 dressed in the north. And that gave us a really huge bump in the futures market. And both fed and feeder cattle were just on fire throughout the day, and finished near the top end of the range. And so, in the case of the feeder cattle, you're $4.50 higher after trading $5 higher earlier in the session. That August contract, it looks good on the day. It clears the 100-day moving average. There's some technical indicators that look good. And now we're within a day or two shot of the highs that we posted last month. And it feels like we're just extremely higher than we've been for a while because of the way we finished the week. But we were there just a couple weeks ago. And so need to see follow through if we're going to call this a breakout. And, different story in the live cattle. June live cattle, which is front month, obviously it's already in delivery and doesn't matter too much to the average trader, but that's the highest level we've seen in the June live cattle since October. And so you're talking a long ways back before we see prices higher than what we saw today. The contracts that matter most now, August to the traders, August came through with the highest trade we've seen since March. But $2 to $3.50 higher in the fed cattle and $4 to $4.50 higher in the feeder cattle. Those are big numbers, and it was all directly relative to the cash trade that we saw confirmed yesterday. There was a little bit of trickling going on today, but most of it got moved yesterday.
But that seems surprisingly sudden, right?
Yeah, very. It makes me think they probably got the Packers probably got themselves painted into a corner and needed to make a move quickly. And with a jump like that, they'll get enough supply to last them for a little while here. In fact, I do know of some that actually sold yesterday for several loads over a period of time at a set price, and so they're booking for a month out. So they're basically trying to fill all their needs through the heart of summer, and they'll use a week like this to get a lot of that done.
So how does this fit in with a seasonal tendency on cattle? Or do you throw that out the window now this year?
I'm wondering, but this could be just a late start to what will be a break. I've got, a jump like this is going to entice some hedging, but I feel that a lot of phone calls the second half of the day today, looking to try to do something, whether it was selling futures or pricing some put options or looking at LRP insurance. And of course, we'll have to wait until 4:30 to do some of that, but we'll be doing a lot of that.
Well, now that's interesting that you bring that up
Mm-hmm.
because doesn't LRP work out better or it's more affordable on a big up day like that? How does that work?
Yeah, so a lot like options, when you have a big jump on a given day, then the volatility skew is to the top side. So the calls are more expensive, and essentially LRP is a subsidized put option, for lack of a better term, and so puts are cheaper on a big up day. So pricing LRP on an up day is really a good move, and that's what has attracted several people today. And so we'll have those conversations a couple hours after this gets recorded.
That's it's just another factor in the game playbook that people
Yeah,
have to look at these days. You got to look
yeah,
at all the angles.
a lot of
And,
moving parts.
well, and with the price of feeders, I mean, my gosh, isn't it going to be terrifically hard to make money as a cattle feeder now? I mean,
Yeah.
for the fat cattle.
Yeah, I mean, you can make money at 196, but I talked about those northern prices. The Southern Plains are still at 185 and 186. Now, granted, a lot of that reporting is fed into some alternative marketing agreements and some grid trade and things of that nature, where they'll actually get some premiums on top of that number. And they may already have a contract where they're, for a certain time frame, they're 5 or 6 over the market on a given day. So if the market in Kansas is 185 today and you have a contract for 6 over, well, you're selling 191. And then you may grid it on top of that. You may end up with 194, but before it's all said and done. So, but you're talking on the actual reflected negotiated pricing, a $10 spread between North and South this week on a live basis. And so it's pretty remarkable. But the point being is you've got live cattle across the board priced in line with the highest cash pricing we've ever seen on a national average.
Well, if you look at the hogs, was that more of a Me Too trade today?
It felt a little bit like that. It was a little unusual to see packers coming out in the cash market and bidding on a Friday fairly aggressively. And I think that cash trade, along with a sharply higher midday cutout and the strength in the cattle, everything kind of was dragging the hogs. Even if they were screaming and kicking like they often do, they still came. And we saw a nice rebound from lows in a lot of those contracts. Now, we did make new contract lows in several of them. And I know a lot of people got knocked out of positions, long futures positions today, and regrettably so, because we turned it around pretty quickly. But you made a new contract low by like $2.50 in the August contract. And so it doesn't look pretty, but the rebound was nice. And so we've got to see follow through immediately. Otherwise that market's probably in trouble.
This may be a localized thing. I just wanted to bring it up here. We have a weird situation here in the Mid-South. I don't know how widespread it is. From what I understand, it's not everywhere.
Okay.
But just in the last, let's say, 2 weeks, let's say a couple of weeks ago, diesel fuel here locally had been running, I'd say 55 cents over regular gas, something like that. Today it's 10 under.
Mhm.
What happened there?
Yeah, it happened all over the country. It wasn't local, to answer your first question, but the second part of the question, I have no idea. they, there was no board movement in opposite directions that would have indicated that needed to happen. This is a time of year where gasoline prices typically do elevate, but it wasn't so much an elevation in gasoline prices. It was a devaluation in diesel prices, as I understand it. I'm not keeping tabs on diesel prices on a daily basis, but from what I heard was the diesel fell, not the other way around.
Well,
This
here
is
it
a
was both.
season.
Yeah,
Okay,
in the
yeah,
Mid-South,
there it was
diesel went
both.
down
Yeah,
about 30 or 40 cents and gas went up 20 cents.
yeah. And so here we had I don't know that the gas went up quite that much, but we did go up at least 10 or 15 cents on the gasoline, and that's normal. But you don't normally see the decline in diesel this time of year. But we did, and this is coming up into I live in a lake town, as you know, and the number of boats and campers and everything moving this time of year is incredible. And so, yeah, you see gasoline prices come up, but to see the diesel fall was a bit of a surprise, and I really don't know the reason.
Yeah, well, just like I didn't understand why it was over $1 higher last winter, you know.
Yeah,
Uh, that didn't make
a
sense
less
either, but
a less refined product that has such a premium all the time makes sense, right?
yeah, I don't know. I just wanted to get your opinion on that because it just seemed like it was fairly sudden here, and
Yeah,
I don't know. I suppose they're putting the screws to the travelers here now that it's a holiday period again. But
yeah,
we shall see. Well,
sure.
Eric, thanks for pointing everything out. My goodness, did we leave anything out? I think we touched all the bases today.
I hope not.
Anyway, happy Father's Day to you and yours and
You as
everybody
well.
out there in the audience. We love talking with you about the markets, as you can tell. And give Eric a call if you got questions about the markets or the LRP that we were referring to a little bit ago. He might
Sure.
have some strategies for you. That'll do it for this episode. Thank you so much for tuning in. For producer Brianne Hendrickson, I'm Marlon Bowling. Hope you have a great weekend, and we'll catch you next time on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.